All right, good morning, everyone. We're back for our Tuesday talk with Brannon, B2R Investing, and we got Justin Camera back from Hawaii. I just saw him recently, but welcome, guys. Good morning.
Morning.
Good morning. Happy Tuesday, everybody.
Yeah. We told Justin put more weights on that rack back there. It looked like he was pumping some iron, but
Yeah, sweat rag and everything.
yeah. But if people tuned in last week, we did had Dion join us, and we kind of went a little bit off topic. We were originally going to talk about Brandon wanted to talk about like ideal or optimizing cash flow. We kind of got into the 50-year mortgage topic though. So this week we're going to kind of dig into the topic Brandon originally wanted to discuss last week. So Brandon, maybe touch on that real quick. What was that all about?
Yeah, so I was thinking, and that's why I put it in our school group. If what everybody thought as a minimum cash flow, because as I was, I've been in real estate and finance for 30 years. So, what was considered good cash flow 20 years ago is a totally different number today. And I think it's changed even more since 2020, what you need to start out with as healthy cash flow, and wanted to have that conversation and kind of see what everybody thinks. And I'll kind of get into some of my points throughout the discussion. But Justin, what's your thinking on it?
I'm a big fan of the 50-year. So and I kind of think of it as a couple because in a perfect world, you'd cash flow with 30-year. Next best alternative would be the 50-year. Next best alternative is interest only. So I like it better than interest only. It allows people to get more house in today's expensive market. So it frees up people. Now, if you use it correctly. Now, it can also be used, negatively as well. But I think if you're using it for a specific purpose, i.e., a house hack or an investment, and I think it's like a no-brainer.
What do you think would be the minimum starting cash flow?
If we're looking at straight investment, in my mind, and I've changed this over time. When I'm looking at the Midwest, when I first started out there, granted this was 2017, I think it was, I wanted like 20% cash on cash. And that was like feasible out there, right?
Right.
In today's world, 10% is not even, it's difficult to get, right? When I'm looking in the Seattle market, I mean, if I can get 5%, that would be absolutely amazing. But in reality, right now, a lot of the Seattle stuff is if you can get in break even, and can be risky, break even today, and those the rates drop, your refi, and then that's where you can make your money. The thought process behind that is that, let's just say 6 months from now, and let's say rates drop at 1%. Well, now the prices go up, and it's going to be harder to buy, even with the lower interest rate. So if it's a good asset and you think it's going to be there long term, and you can break even or better today, it's a calculated risk that I would take.
Gotcha. Kind of, where I land and what I saw in the discussion, and there was quite a bit of engagement before I put a number I thought is 250 in cash flow starting out is where I'm trying to land or better. And the general consensus was most everybody put $200 or higher was the general consensus. And I remember 20 years ago, if you were getting $100 in cash flow, 100 to 150, that was considered great cash flow. And so I think now in today's market, 250 and higher is considered great cash flow. But to secure the property for the long term, and this is what I wanted to discuss, is I know we talk about cash on cash return, and that is one metric, but it misses something. And I think there needs to be two things being evaluated both at the same time, is a minimum cash flow threshold and the cash on cash. And you said it, Justin, when you're looking in different markets, the yield is different. Midwest yield, it seems like, because I'm not in the Midwest, is 10% is attainable. In the coast, it's less than 5% or zero. In my area right now, this is the importance of knowing what average is. In my area, even here in North Texas, the average is around 3% cash on cash return with 25% down. So then I'm very competitive. I say, well, I don't, who wants to be average? I never want to be average in anything. And so I'm looking to 3X that return. And so I've been able to attain that 10% plus cash on cash with brand new properties. So that's just, I think the minimums, because what we look at even in the market now, and I do think this is more, not every single spot, because every spot's different, but generally nationwide, rents have softened, and especially in the Sun Belt area, the rents have softened. And so when you're looking to buy a property, how you underwrite it and making sure you're not going to create a alligator, a negative cash flow. Give example. So, what we're seeing now. So say I were to get 10% cash on cash return in an area that averages break even. The example is I bought a duplex. I did 8% or $8,000 in closing costs, and my cash flow is $800 for the year. I'm getting a 10% cash on cash return. Is that healthy? And are you in a very precarious situation? What do you think?
Is 10% good with 800 and 8,000?
So you've got 8,000 in it. So you're at 100% loan to value. You paid for your closing costs and you make $800 a year.
I'd be all in on that. Like, I do.
What if expenses change?
Let's see. If expenses change, now this is where you get into.
Yeah, this is where you get into some dangerous situation.
If you are at a $100,000 property, a percent change may not be very big. If that's $1 million property, percent change can be really big. So that's where, because some of the properties I have are to get that cash on cash return or seller finance. So low, just like you're talking about, low percentage down, but small monthly cash flow. But when you do the math, it's still high cash on cash. But if you have one big expense, you can get upside down pretty quick.
I look at it as the law of small numbers. The law of small numbers distort analysis and distort reality of how good the property is. The lower the amount of money you put down creates a disproportionate wrong analysis. What if you didn't put anything down and you made $1 a month? Is that a good property?
Infinite return.
Yeah. Is that a good one?
It's like when you get your MBA, the answer is it depends, right? So if it has good cash flow and good condition, low potential for bad tenants and stuff like that, I would take that.
Interesting.
So a few people are commenting. Charles Helicopter McCune says, "I'm not in on that at all. Too skinny." Yeah, Charles is looking to buy, or he's not looking. He is going to buy a helicopter for his wife Carrie.
Yeah,
for Christmas.
Well, I know these aren't necessarily. I'm just trying to create something that is not reality to illustrate a point. That for me, I want safety in the property. And here I am, I was talking about, I'm about to turn 54. I don't want to have a chance ever, as best as possible, to go negative or lose the property or damage where I'm going financially. And I think the cushion of $200, for me, $250, but a lot of the group said $200. I think that's safe, because what we've seen since 2020 is a lot of expense explosion, both from property taxes to insurance. If you are at a very thin cash flow, you can very easily become negative and get into trouble. That's why you've got to have some margin.
I'll just say it out loud instead of typing it. Justin, so you can reply to it, but you'd have to have your open to the stream, like either your phone, yeah, and then you can comment back to Cody. But Cody did say zero chance of doing that. Debt coverage matters too. Yeah.
Right,
So
exactly. It does. But I'm just trying to illustrate a point of you need to have some cushion. I had a property that was started out, and this is a brand new property, started out at $200 a month cash flow, and now it's down close to 100 because of insurance and property tax escalations. But I had some margin in there. If I'd have been at $100, I'd be break even now. And I'm doing things to different states have different ways they do property tax. I protest my property taxes every year. If I did not do that on that property, I would be negative cash flow today. I I learned, and I know some of y'all know this. I was elected to the committee, to the board of our appraisal district. It was for me to learn how to play the game. That was going to be, I wasn't getting working, I wasn't getting paid for it. But the value is me learning and having an influence, but also how to play the game when I'm protesting my property taxes. What is the appropriate way to protest to continue to lower the property taxes or at least manage the growth? Because I've got quite a few to help save me money over the long term.
what do you think about Ryan Ruff's comment? Says that's when you rise your rents.
Raise your rents.
Yeah.
Okay, what if you're in an environment, and we're seeing that at least where I'm at, in an environment that rents have actually declined. The average rents in North Texas have gone down about 5 to 7%. I underwrote my properties with that in mind. I'm trying to mitigate my risks every which way. When I'm saying I want 10% cash on cash return, that is based off of low average rents. So I take what rents are, knowing what rents are in the area, and I want to look at my cash on cash with rents being 5% below that average rents for that area for those properties. And I want to be 10% cash on cash return. My break even is almost between 15% and 20% below market. So I'm trying to protect my properties, not just for today, but for the long term. When I'm looking at my investments, I want to look at every which way to make sure it doesn't go negative.
I do see, where did it go? Is it Caleb Easy Sell Texas? I think coming in from your channel, Brandon. It says, "What do you guys think on build to rent during this market?" Oh, great question. Yeah, because that's your strategy. I know Justin is thinking about doing something like that too. So, what's your thoughts on that, Brandon?
I mean, it's been working, now for me here in Texas. The issue with Texas is we have lots and lots of land. So land is relatively inexpensive in the suburbs. It gets more expensive, of course, naturally when you go into the metroplex or the city centers. So I have metrics of what I'm looking for. I'm looking for older subdivisions that maybe all the infill lots didn't sell out. And sometimes you have old cost models when they built the utilities into it. And I've been able to find pricing that works.
Sorry, I was sharing Justin's YouTube channel and his Instagram page, so go check that out. He'll be streaming live next time from his channel. He had to wait the 24 hours for YouTube. But Justin, I know you kind of mentioned offline too that you're possibly looking at maybe into the build to rent strategy. Is that correct?
Yes, but I do want to address the guy that said this is where you raise the rents. Some people you're talking about rents decreasing. I think Cody mentioned 7.5% down in Moses Lake, which I have a property over there. But the other thing that's a big thing for your blue states is now that we have rent control. So like we can't even if you want to go, say your property taxes go up greater than 10%, you can't go more than, I think it's 7% plus the I think the consumer price index increase. So for Seattle area, that's like 9.7, I believe, right now. So if your taxes go up, you can't just raise it the same amount as your rent. So that's one thing that we have to contend with in this market out here. Now, addressing the question on build to rent, yes, I'm super interested on build to rent. I'm doing a short plat, like, which has been taking forever. I'm almost 2 years into it, but it should be done in the next couple months. Then I'll have a free and clear land. And so the original plan was I can throw a manufactured home on there and probably gross about 150 if I sell it. But then I'm like, man, I went through all this pain and effort. I'd rather have like a long term good asset. So I'm like, well, what if I do a build to rent? Because there's some like around this area, there's some off the shelf designs. It's called Highline Homes or Dare Homes, where you can just basically say, hey, I want this duplex on this property. They have it all priced out for you. You know, it's been a couple months since I looked at it, but rough numbers is around 500K all in for a 3-2 one car garage. And you know, I'd have to do some site work, so call it 600 all in. So I'd have to be about an 800 to get a full BRRRR, and then you know the rates would have to be at around 5.5% to be about break even. So that's kind of what I'm looking at doing, to where instead of taking the quick money and then having to pay tax on it, why don't I roll that into a build to rent model and have a long term asset? Because what I'm realizing, and maybe since Cody's on here too, like a lot of the properties I owned are older properties, and so in the Midwest, the reason why they're cheap is they're old, and there's a lot of them, right? So I have massive capex expenses, so I'm trying to trade out of the old and get into the new. So if I could get a brand new asset that, you know, theoretically 10 years should have minimal, that would be a minimal capex. That'd be sweet for me. That would take out the variability of my income stream.
Yeah, Justin, that's one of the things I've looked at in, I started construction on my first ones in 2020. They didn't go live where I could rent them until 2021. So I've had them roughly 4 years. I do hire a GC to build the property. So I have a builder's warranty on the things that I do, a couple of things during the build process. So with 12 units now, I've spent a total of roughly $2,800 in total expenses in 4 years on 12 units.
Wow.
So it has allowed me, because I do start out. So if you look at older properties, and we'll talk about something else, lower rents. But if you have older properties, your allocation for reserves or for maintenance, vacancy, and capex, 15% may be a good starting number. It might actually be higher depending on the property or what you need to allocate. And you're spending a lot. I start out at 8%, and I have been able to build up. Now I'm close to 40 grand in reserves built up over 4 years, and I've only had a total cost of roughly $2,800.
I love it. It's a feedback from a wise investor. Like my whole investing career until recently was full stream ahead. I would just earn more income and not have reserves, which is great when you have like the W-2 steady income. But as you leave the W-2 world, the reserves are paramount. So I'm shifting into exactly what you're talking about, setting aside reserves for the properties such that when something breaks, the money's already there.
Yeah, the money's already there. I'm looking at something. What was I looking at today? Well, just recently, I had my very first build. Of course, we always learn a lot on the first build. I didn't put in a fence. And so because I had the reserves, man, it was a no-brainer. I'm adding value and I'm adding where I'm getting more rent and more appeal. I went and pulled the trigger on this fence, put in a brand new fence for, I think it was somewhere around $3,000. It was no hesitance. I had the money. I had plenty of reserves. And so it allows you to make a few little changes on the different properties. And I'm working on another one. I can't think of the other thing. It's a small $1,000 change, but it's a positive value add when you've got healthy reserves and you're continuing to put up more and more every month because you don't have many expenses. It gives you freedom to make little changes, or it just builds up. I'm looking, for me, to protect this property. There's lots of ways you underwrite it, like I've been talking about, but reserves are further protection to keep the property long term. I want to have my goal is 4 months of all the expenses, including the mortgage payments, for me on these 12 units comes out to $55,000. And I want to hold those 4 months in there. So I'm roughly close to 40, and I'm rapidly getting closer to that 55. Then, now granted, I'm still growing. So then when I get new properties, that number changes. But I'm keeping it so that I have to think, I'm closer to retirement. Heck, you're ahead of me. You're 10 years younger than me. I have this window to make it, here in my 50s, completely where these cash flow paying all my expenses. I've got to do some things a little different. Same with the build to rent. If you're buying these properties from Lennar, DR Horton, you name it, and I see some people doing that, it is getting some traction. I've seen several articles just recently on build to rent, but they're buying them from the builder. They're getting a good deal and maybe it cash flows, but they're not getting the equity. I looked at it for me, how can I create wealth that doesn't come from me? If I'm putting 25% down, I'm just moving pockets. I'm moving it from cash over into the property. I haven't gained any equity or any wealth yet, other than when the tenants start paying down the principal and whenever appreciation starts happening. And it hasn't happened in 2 years, and I don't think it will unless the 50-year mortgage comes out. There will be some appreciation for a little while. I created it in a sense out of thin air doing the build to rent, because I was able to build them with 20 to 22% instant equity in today's market. I'm building them for 200, 205,000, and they are legitimately appraising for 260 to 265. I've created wealth out of thin air.
And I know you touched on property taxes and disputing that yearly, Brandon. So Jerry Mills, tuning in from your channel, says, do you offer teaching on how to dispute property taxes?
I haven't, because every area is a little different in how they do it. We have a county that allows you to look at both the sale approach or the income approach. Not all, even in Texas, not all counties will allow you to do the income approach. They'll only use the sales approach. So you have to look at which one, and you've got to be able. So the biggest one is the sales approach. You've got to go with those numbers, and I'm looking at where the market is, and I'll have 4 or 5 examples if it's the sales approach, and I'm looking at as apples to apples and in the condition that they are. Even on these new sales, here I'm building new properties in a predominantly owner-occupied area. Sales prices have come down, and I'm constantly monitoring them. And I'm taking those, or I know a counties that they will give you, because I'm building them, let's just say 200,000, I can go with my actual build cost instead of retail and say, here's what my build cost was with that contract, and the counties will match what I actually paid to build it. So I will get it valued year one at 200, even though they're selling at 260, because I brought the actual numbers and the contract, and they will put it at 200,000 year one. Well, there's a tax break.
I'm not sure if you know Jerry Mills, though, Brandon, but he is on tuning in from your channel. But he says, I'm breaking ground on the first phase of a 30 townhome unit development of my own, B2R.
So
Uh,
yeah, you've got to find out, Jerry, if your area will take what it actually costs you to build them. And I went ahead of time. So maybe that chief appraiser, depending on what the title is in your state, I don't know what state you're in, um, they might accept the value being taxed at that value based off of what it actually cost you to build. That might save you money. In our area, that does save money. The area that I'm building in currently is outside of the city limits. So that saves 1% in property tax. Here in Texas, most of the area is taxed between 2.2 to 2.5% of the value is the property tax in a city. If you're outside of city limits, you don't have city taxes. So I found an area that is right on the very edge of the city limits. It saves me 1%. So the property tax in this area runs 1.2%. And that's low for Texas. So I'm at 1.2% and I'm taxed at that. Well, that on, let's just say it's 260,000. Well, that's $2,600 in tax savings a year. And that on top of what the already cash flow is, if I had to net that out in expense, it would still cash flow, but not having to pay that city property tax makes it a great investment. And I just saw Indiana. Yeah, I just don't know, other states how they operate.
I do also see Ryan Ruff, who also will be speaking at the Vegas event in February. He's also mentioning that they are going to be transitioning to some build to rent for affordable housing. So they're in Toledo, Ohio, and are moving in that direction. I know you had some stuff you want to share on your screen also, Brandon. Was there some
Yeah.
things you want to
Let me
put up
get
there?
to that first. Let me answer a little bit of that, Ryan and Justin, what you're talking about. So when I was looking to do build to rent, let's talk single family. I looked at the median sales price in that community, and I said, I want to be 20% under median. I'm always thinking bailouts, I guess. Maybe I'm scarred from '08 so bad, and I remember what happened in '08. I want to have paths of success or paths out that I don't lose everything. So I looked at this area and I said, I want to build at 20% below median sales price on these single family homes of my appraisal. I know I'm building way below 20% my cost, but I'm saying at appraised value when the market is selling at $365,000, $380,000 is the median. Having homes at 260, if I were to choose to have to sell, I could that much easier sell because I'm below the median. So I think of all those things. So Ryan, I hope that helps think through some things too. I'm thinking of not only the cash flow, but I'm thinking if I need to sell it at any time, sell it for any reason, how much easier is it for me to sell?
One follow up on that, back to Ryan's saying, is he put in there affordable housing. When you're doing affordable housing, there's usually some sort of kicker for you. You can get more units, you can get more square footage. They subsidize some of the money. Like in
Yep.
the past, I did some affordable housing work where they would do 50% of the rehab. And then as long as you did affordable housing for 5 years, that loan that they gave you is wiped clean. So if you can get into the city, find whatever these buckets of money are for affordable housing, that could be a way to help protect from the downside.
Yeah, that's true. There are incentives for that.
Yeah, it looks like he
Sure.
says yes.
One
Um,
one follow up to what you're saying about the build to rent model there is that um, your unique capability, your unique value add is you have construction background, you know how to find these deals. Not everybody has that, but everybody has some sort of unique thing, right? So Cody Davis is obviously creative financing, right?
Yep.
For some people, it's finding deals. For some people, it's just they make a lot of money and they don't need to, they might buy that from the developer 20% down because they don't need to spend that much time because they can make more money by whatever their income generator is. So I think as long as you're aligning your unique value, your superpower, whatever you want to call it, that can help you scale up your portfolio.
No, Justin, I do agree with that. It's not one model is right. You have one model that's right for you. And a lot of times it's your market and your skill set, what your background is. And everyone's is different. And I agree, that's a great analogy. Mine, I grew up building houses. I can see those things and enjoy it and have lots of contacts, relationships to get it done. Cody's was relationships and superpower of structuring uh, private financing and got in that. Everybody has a different skill. Build to rent is not going to be right for everyone. You know, everyone's is different.
Mick is saying these new builds outside of town cash flow day one. Did you say rents are down due to builders like yourself?
Me building 2 properties a year, I don't think is affecting the rents. But I will say in Dallas, this is all of the Sun Belt area. Hundreds of thousands of apartments and syndications have been put out there. In Dallas, Fort Worth alone, they've added 50,000 new units just in DFW. That
Actually,
does affect.
before we move on too, I keep forgetting to mention that Justin has joined the school community. He just hasn't introduced himself in there yet. But we did it live. When he was in Hawaii, Mikey, I'll say Mikey bullied him into joining school. But Justin
Well, it
is
was
in school.
you gave me the $20 and you said you have to join. So I'm keeping this $20.
But so he is in there. Go look for him. He hasn't introduced himself yet, but Justin is in the school community. So go reach out. And if those that haven't heard, looks like we've hit the 500 members. So Zuber probably will be putting together his live with some of his weekly guests to do a live stream. I think in the evening, he said. And he's also going to open up the How to Get Your Money Right course in the school community. I do see Nick. Hey, my Bitcoin man. We're going to start doing a weekly thing once he gets back from his travels. But he says, I built the ADUs and
Yeah.
have instant equity more than it cost me to build here in California with 1% rule, easily for cash flow.
Yeah, I do. I do use that 1% rule. It's kind of a quick back of the napkin because I know, but I also know what my build costs are. So I'm looking at a property and I'm like, okay, but first you have to know what rents are. That's the first thing you have to know is rent prices. What are they going to get in that area for that specific type of build or that 3-bedroom or a 2-bedroom, you name it. You've got to know that. And so then I'm looking at a property, I look at what I should be paying for the dirt. That video that came out, I think it was 2 or 3 weeks ago. I went through it on a whiteboard, a step by step of how I evaluate day one on finding property and what I know it costs me to build. But let me show you one here. Let me share my screen if it's okay, Mark.
Did you press it? I didn't see anything yet that popped up. So usually you gotta share and then you gotta choose what do you want to share. It'll say like your window or it will give you an option of what do you want to share.
Yeah, it's making me open all kinds of stuff here.
Oh, these damn boomers.
I know. Just let me share it. I hit the button.
Maybe a future, while you're doing that, maybe a future topic is since I'm looking at build to rent, Brandon, if you want to, I can get the data from the builder and just kind of run through the numbers. We could do a live analysis on should I build to rent a duplex at once my short plat's done on the new lot.
Yeah, I can't figure it out. I don't know. Stupid piece of crap.
Well, hopefully your presentation doesn't turn out this way in Vegas. Hopefully
Yeah,
you're a
no,
little
that
better
I
prepared
got
for that.
dialed in.
Well, you know what? It doesn't matter because we do have a lot of questions actually still yet in the chat. So there is, like I said, Caleb, Easy Sell Texas from your channel is asking, I have private money. What do you think of using it for the construction part and refinance with a DSCR loan? I am highly considering it.
No, I mean, that definitely is possible. I'm looking at it. If I had somebody offer private money, I'm going to compare it to my bank financing. If that private money's better, why not? It just depends on what the interest rate or what the terms are for that private money, and moving it over into the DSCR after construction's completed. No, I would consider it.
So Victor, who's also in the school community, who's doing a lot of big things in Mexico, I believe, or new build, but he says, I build to rent here in Mexicali, Baja California, Mexico, and have approximately 18% cash on cash return approximately. The difficulty is to refinance apartments. Interesting.
On
Here.
that one,
Yeah.
instead of refinancing, say with a bank, potentially you could get a private note on some of that as well.
Big Cody Evers, who congrats. I know he just went under contract for a new property, but he's asking, what's your build style to get cash flow? Small units, 2 to 3 bed, etc.
I have done a 2-bedroom build. These were up down units. That was my first build. So it was a 4-plex at 2 bedrooms. In my area, am finding more turnover with my 2 bedrooms than my 3s. So the next one I built the next build was a triplex. I did it townhouse style. Those are 3 bedrooms. I haven't had but 1 turnover in 3 years. So my 3 bedrooms are working better than my 2s.
Hyder says, Brandon, employ your kids to fix your tech.
I know.
And yes,
True.
for people that haven't heard, Zuber is offering 20 spots for kids, teenagers to attend the event in February for free. I know about 5 or 6 people that may have reached out to him already, so I'm not sure how many spots are available. And the other bonus you do get is that Cody Davis has offered to have one-on-one sit downs with these kids, teenagers to kind of talk about finance and maybe their thoughts on their future and whatnot. So hey, you get a bonus, so you can bring your kids for free, and whatever ticket you purchase, they'll get the same. So if you get VIP, they'll get VIP also.
Yeah, I've got my daughter. I've mentioned her on these videos quite a bit. I've got my daughter that's coming. So we've already bought the plane ticket and we already have it set up. We're working with the school to allow her to have those 2 days off and not count against her. The school's actually working with us. I have to write something to the school saying, here's what she's going to learn. And I'm going to put a lot of that of what Cody's bringing to the table. It'll be neat to see a lot of these Gen Zers, and what Michael's doing is really trying to hit this age group with Cody and Dylan speaking the next day. I think he speaks right before me. And then offering these teenagers to come, they're getting something that school doesn't teach. And that's financial literacy and a path to financial freedom that none of the schools are teaching. And that's what I'm going to put in it. So I'm excited to bring my senior in high school. She's going to be coming.
Couldn't she just be sick? Like, did you have to go through the whole thing of like?
Hey, man, we're honest and we're trying to talk to the school and work it out.
I'm just saying, but all
Well,
right.
what they're doing though, here's why. Let me just speak to that. So if you're sick, our school does, if they miss 3 days or less of school, they don't have to take finals, no matter what the excuse is, 3 days or less.
Wow.
So she wants to make sure those 2 days don't count against her, because we've got, we live this Hawaiian life. We're heading down to the beach maybe next week, and then maybe again in January, and then again in April. Well, April, we go down for a thing called Sandfest. We're missing 2 more days for that don't count. So we're trying to make sure we're protecting our Sandfest
All
trip.
right, okay, that makes sense then. Jerry Mills, tuning in from your channel, says we are building 2 and 3 bed, 2.5 bath units. Wanted to have both options on the units, 2, 3 bed.
Jerry, I have thought of that too. I've got one more multifamily, and what do I do? A mix of 2 and 3 bedroom. I'm just, I've got the 2 multifamilies. One's a 2 bedroom multifamily, one's a 3. And then I've got single family builds. I'm just finding my 3 bedrooms in my area stay rented longer. I have 7 3 bedroom properties, and I've only had one turnover in 3 years versus multiple turnovers on my 2 bedrooms, which costs money.
All right, see, I'm getting in trouble. Coach Nick, the teacher, says honest is best way. It's called independent study. School gets paid and student gets credit for days missed.
I don't do government schools.
Ah,
Let's see. Mick says, so the 3 bed triplex, what's the rent a door? What is the cash flow on that bad boy? Cost to build out the door.
Okay. So this 3 bedroom, I'm averaging 1825 on the 3 bedroom duplex, and it cost me 520 to build. Plus on these 3 bedrooms. So I've got the three bedroom units getting 1825, and with that build, I built 5 10 by 10 storage units on the side of the building, and each of those storage units gets $50 a unit.
so it's about 174 a unit, 1850, I think you said. So just over the 1%.
Yeah, it's just a hair over. And that was the one that I got hit pretty hard on property tax and insurance. Well, all of them on insurance. I'm fighting every one of them. I went from basically 2,400 to 4,000 in insurance, and I've shopped it 100 different ways, and I can't get it. I'm doing higher deductibles. I'm doing everything I can to mitigate that cost and be still protected. And that's roughly where I'm at.
Jerry Mills is asking, what is the school group called? So it's Michael Zuber's
Yeah.
one rental at a time community. I did put a link in Brandon's channel, but if not, you can always reach out to Brandon or myself or even Justin now that he's in school. But yeah, it's 67 pennies a day. I got 6-7 out there, so hopefully
Yeah,
it
there
helps
you got
the
to get
algorithm.
6 7.
So 67 pennies a day. I am paying for people's first month, like Justin, like he was in Hawaii. So just if you find me on Instagram or something, you can message me and we'll figure out how to reimburse you. And if not, if you're also interested, there is a Vegas event in February for Michael Zuber's one rental at a time.
Jerry, you should come. It is truly beneficial, and I'm excited. I think this year's speakers, I'm very excited for all the speakers. It's February 14th weekend, and it's also the networking. It's all of us getting connected and having just the offline conversations, even though Marc gives me a hard time every time I talk to him and talks about how did I get this wife to stay with me, and now you're going to see my beautiful daughter, the homecoming queen, coming with us, and just, you need to come, Jerry.
Yeah.
And I mean that legitimate. I'm not selling. I'm not getting paid for it. We call it the ORAT family reunion, but it's also just phenomenal learning from people that are doing it. That's the benefit of this group. Vast majority are actually doing it, not just coming to conferences, listening about it. These are people that have experience.
Yeah, I'm looking forward to all the speakers except one, but I won't say which one.
Yeah, I know. Hey, I'm
But
worried about that speaker myself.
but Justin, maybe Jerry's not sure who you are, Justin. Maybe give Jerry who you are, where you're at, and what you invest in. You talked about the Midwest a little bit, but you also talked about the Pacific Northwest. So maybe fill Jerry in on who you are, Justin.
Yeah, I started back 2016, a little bit different from the people on the call. I started in the tech side, so I was working at Amazon, and I was like, how can I get it out as fast as possible? So I started with a house hack in Seattle. Then I had a 11 unit in Yakima, which is 3 hours east of Seattle, and then I started expanding into out of state because I started seeing that it'd be much cheaper to acquire cash flow out of state. So it started in Milwaukee, Wisconsin, 2017. And then I was in Detroit around 2019. And then most recently, Des Moines, Iowa, 2023. So I did a rapid expansion from 2016 to 2022 to 45 properties, 145 units. I'm now I've done some restructuring, getting rid of some partnerships and the alligators. I think I'm around 32 properties, around 88 doors, something like that now. And I'm not in Michigan anymore. So I'm just in Washington, Iowa, Wisconsin.
Very cool. I saw Dion was here earlier also. I know he's heading out on his trip, so I'm not sure when his
Yeah, I thought
flight
he was
is,
heading
but
out today, maybe.
he is heading out today. So those of you, but don't worry. There still will be a live stream. Zuber and Lumberjack will be filling in for Dion at 4 p.m. Pacific, so you'll still get your weekly Tuesday live. So Zuber and Lumberjack will be there.
It takes
Uh,
people to fill his shoes, huh?
Exactly, yeah. So I think Zuber's committed to 2 hours. So if it goes long, but he's told Lumberjack he'll do 2 hours on the live stream. I see Jen tuning in. Jen has a lot of stuff planned, I think, to kind of make this event a little bit better. She's putting together some name tags and how to have people check in more smoothly. I think that last year. Last year there was a little not hiccup, but it took a little bit long to get people checked in the door. So I think this year she's working on some things to make it a little smoother.
And I think we need
Um,
to
Damn it.
mention too, there's less than 100 tickets left. So Jerry, if you're looking at it, I would look at it very soon. He's almost sold out, and there's no room for additional tickets.
Very good point. And Jerry, I'm not sure if you heard. I'm not sure if you have any kids, teenagers, but Michael Zuber is offering also for them they can attend free with their parents or whatnot. So whatever ticket you do purchase, they can attend free and also get a chance to speak with Cody Davis one on one, who's my Monday weekly regular guest. Dion said he's skipping Hawaii. Okay, hold on. We gotta do something here. Justin, tell Dion that he shouldn't skip Hawaii, and then Brandon, you also tell him why he
Oh
shouldn't
yeah.
go Hawaii. So Justin, you go first.
I'm a big fan of Hawaii. It's more of a chillax place.
Hmm.
But truth be told, I'm more of a Mexico guy because the value per money spent is much better. But I am a big fan, and the last couple of years I've been going to Hawaii because Cindy, my fiance, has work stuff there. So the best kind of travel is when you're a plus one. You have no responsibility. The accommodations are all paid for, so it's the easy life.
Brandon, why should Dion go or come
Oh,
to Hawaii?
Dion. Well, I think Dion, he's going to choke over the prices. So I get that. He is going to choke. But we enjoy it. I was just telling Mark that we've been twice now, and we're planning our next trip for not this February, but the February after, to go to whale season and see the whales breaching at that time. It's the peak whale season.
Let's see. Yeah, Mick is saying I'm thinking of going to Vegas just for Dion's night meetups. He says sorry, pace. So there you go. So yes, Mick, there are Wednesday, Thursday, Denny's midnight meetups, and there's also a Friday morning coffee that Brandon is putting together. So if you're not a late night person, Brandon is putting together a Friday coffee meetup at Denny's also, I believe. Jerry Mills is asking, what about bringing some family team members?
Yeah, I mean, I've brought now my wife comes. There's, do what you need. You think that it'll be valuable this year, and not just the speakers, but the networking, building other contacts. I've brought my wife and some other friends.
All right, sorry, like I told everyone yesterday, I forgot my son had JPO this week, so I do
Yeah.
have to wrap things up a little quicker than normal. But we'll end on this one because Dion, one of my recent reels was also Dion kind of touching on this about some people getting into multiple markets. But Hyder does comment, Justin and Frank one own properties in all 3,000 plus U.S. counties. So if you were starting over, Justin, would you kind of go down that same path and be in multiple markets, or would you change your strategy if you know what you know now?
Knowing what I know now, and the more I hang out with Dion, less is more, right? Because like the my very first property, it was a house hack, and I net like 5,000 on that one property. What if I just did 4 of those? 20K a month, easy money, right? So over time, I'm shifting into less is more, and I'll probably do more of the build to rent, and specifically in Seattle, it's more about ADUs, detached or attached. So I'll probably shift more of my time and attention in there. I do have a real estate agent team, so it's helping me source deals, and then the money on the agent team I make can help me fund my own deals as I move forward. So I'll probably be way more local, keep the ones I want to own greater than 10 years out of state, and then I'll probably 1031 the rest of the out of state into future upside equity plays in the Seattle area.
Yeah, so if you want to reach out to Justin, there is his Instagram page and also his YouTube channel, which will be streaming live from next week. He just needed to wait the 24 hours. So if you can jump over to his channel though and subscribe there. And I don't like promoting Brandon's channel because he's past me or he's catching up to me. But if you haven't, though, here is Brandon's B2R investing channel. So go check it out. He does a lot of cool stuff there. So go subscribe if you haven't yet. But any final words you guys want to wrap things up before I got to row? Brandon, anything?
What I was thinking about in the different areas is be careful, a caution tale of focusing on concentration on one strategy, diversification on geography. Consider that heavily and try not to do all things. There's one model that you're usually the best at, one type of investing.
Justin, any final words from you?
I think we were talking about unique value or your superpower. One of the, when I boil it all down, there's really like 2 things or maybe 3. One, just consistency over time. 2, massive action. 3, low cost of living. And all 3 of those, anybody can do them. You just need to do it, right? So that's really like the way that I was able to build so fast. So it's a simple way to do it. Just got to get in there, do the hustle.
And we'll wrap it up with Josh Burdick's comment then. It says, imagine learning to ride a bike online. At some point, you got to saddle up.
Yep.
All right, everyone. Thanks for tuning in. Sorry, I got to wrap it up a little shorter today. I'll see you everyone tomorrow. I'll be back with kind of my wacky Wednesday one with Joe and Lauren. It's a little more entertaining, kind of off topic. But we're also going to have an agent from Florida on tomorrow. She does like vacation rentals. And we're going to see if the vacation rental market is dying out there. But everyone, I'll see you folks tomorrow. And thanks, Brandon and Justin.
Yep. Thank you.